Over the past week and a half, we have seen crude oil prices surge to a 13-year high. And this has led to many people asking, how do I buy oil? Many people see this as an easy way to make a lot of money very quickly on the markets, but as you know, everything that goes up must come down. And if you have already placed trades in oil, you may be asking yourself, what on earth happened? And is it too late to get a piece of this cake? This is 3 ways to buy oil. As mere mortals, we're not going to be buying oil tanker quantities of oil where we store said oil, then hope to make money per barrel. No, what we need is something that's going to be more flexible, that allows us to liquidate our positions relatively easily without incurring the storage costs. Luckily, there's more than one way to skin a cat. There's definitely more than one way to buy oil. You can invest in companies whose business is to get oil out of the ground. Now, there's quite a lot of global players in this space. You've got the likes of BP, Shell, Gazprom, probably not the best example right now, but you also have Chevron, ExxonMobil, just to mention a few. Now, in the example of Chevron and ExxonMobil, Chevron has seen a 51-point increase in its share price at the beginning of this year. ExxonMobil has seen a 21-point increase. Now, the game here is to essentially buy these companies, hold their stocks in the hope that because we still need to put petrol in our cars, they will be profitable over the near to medium, even long term. And that's where you're going to make money. But if you are going to be buying these companies as individual stocks, it's really important that you understand what the trajectory of this business is all about. Doing that fundamental research, balance sheet, membership teams, what the plans for the business are moving forward. One thing we have realized through the conflicts going on with Russia and Ukraine at this point in time is the fact that we need to have dependable sources to provide our fuel and our resources that don't necessarily have any geopolitical tensions. We also know that there is a huge movement from a global point of view to move away from fossil fuels. So one of the key pieces of research that I believe is going to be a key point for you is what these businesses are doing in the renewable space to move towards renewable energy. ETFs and mutual funds are a great way for you to gain exposure to oil without being dependent on a handful of companies for all of your investment returns. Essentially, an ETF or a mutual fund will have you invested in a basket of companies in the energy sector. What that essentially means is that you'll be diversified away from the risk of only having 2 companies like Chevron or ExxonMobil, and you're going to gain exposure to a whole host of other companies across different geographical regions to help you ensure that you are able to get a better return from your investment. Now, this doesn't always mean that you're going to have success 100% of the time. It doesn't absolve you from market fluctuations and market volatility, but what it does do, it gives you a greater chance for success. Now, there are lots of ETFs out there. For example, you have the iShares Global Energy ETF, which provides exposure to the largest energy companies globally. That will include the likes of Exxon and Chevron. You also have other ETFs like the SPDR S&P Oil and Gas Exploration and Production ETF, the iShares Dow Jones US Oil and Gas Exploration and Production Index Fund, and the Invesco Dynamic Energy Exploration and Production Portfolio. All of these are going to give you exposure to oil and oil companies. The key piece of research to do here is simply the objectives of the ETF and maybe have a look at their total expense ratio for cost as well. CFDs, or contracts for differences, allow you to gain exposure to oil, and it allows you to play both sides of the equation. So if you wake up today and you think that oil prices are going to go up, you could place a trade, a long trade, and benefit when oil prices go up. Equally, if you think the oil prices are going to go down today, you could place a short trade and benefit when oil prices fall. Now, conversely, in both situations, if the opposite happens to the way you've placed your trade, obviously you're going to lose money. Now, this is exactly what this gentleman who posted this comment basically did, only he leveraged his position not knowing that that's what he was doing. Now, leverage is when you are investing, you place a trade and you have a capital of, say, £100. If you use 5x leverage, it means that you're putting in £100, but you're actually borrowing an additional £400 to trade with. Now, if I wanted to place a trade for oil, it's relatively easy to do. All I would do is click trade right here. and I would need to choose whether I think oil price is going to go up or whether it's going to go down. If I think it's going to go down, I would click sell. And I have $300 here with a leverage of 10x. This tells me that my total exposure, the total amount of money that I could lose, is $3,000. Now, you don't have to use leverage if you're using CFDs. And if you're only just starting out, I would strongly encourage you not to use leverage. You're borrowing money that you don't have to place a bet. If you're making money, that's great, but if you're losing money, that is not great. And it's very simple to change these options. So at the moment, I'm on 10x leverage. I could go down to 1x. 1x is simply you using the money that you can afford to lose within this trade. Now, obviously within CFDs, you get to set your stop losses, which is this right here. And you can also set a limit where you will take profits as well. So if you hit either of those limits, it will cash you out of that trade. The bottom line here is if you are going to be looking at CFDs, please remember that it is higher risk. I actually made a video a while ago which talks about the pros and cons of CFDs and how they actually work. That will be pinned in the end card right here. I hope you enjoyed this video. Take care.